Hey everybody, this is Dr. Duru from Ahan Analytics with the market breadth. Okay, we got through another week without any big negative headlines that impacted the stock market anyway. And I thought it was going to be an all clean, all signals go for this timestamp of May 16th after market. But we did get some late breaking news that Moody's dropped the US from its top credit rating. That means the US no longer has any top credit ratings. This is a bad mark on the financial credit worthiness of US government debt. Let's see what happens on Monday. Long-term yields might go up a little bit. I'm sure the stock market, if it does react, it'll be very shallow. We're back into this complacency mode that I'll describe when we look at the indices. So I don't really think this is going to be a big deal for stocks, maybe for the bond market for a little bit. Like I said, there's not much big news here. There's a lot of stuff in here, company, business, and economy wise that I'm not going to cover here because none of it is really all that market moving. So let's jump right into it with my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. It finally ended the cliffhanger, which we started the week. It was right below this overbought level, and today it broke through, very clean, sliced through this overbought level. Overbought is when 70% of stocks, at least 70% of stocks in the stock market are above their 50-day moving averages. And what does overbought mean? Well, it's not just the fact that the vast majority of the stock market is above their 50-day moving averages, but it also means that a lot of buying power now has been expended to get to this point. And the odds are, under my typical what I call AT50 trading rules, is that the odds favor some sort of pullback, some sort of cooling off before the rally resumes. Now you can see last year the market could not hold overbought conditions at all. There was only one breakthrough, and then after that, it just kept hitting, and coming back down. A lot of that was because of weakness in small caps. But now what is very different than last year is that we still have a lot of stocks that whose trend lines, 50-day moving averages and 200-day moving averages are in downtrends. So number one, it was much easier to get to overbought. I mean, look at this. We were deeply oversold just a little over a month ago, let's say 5 weeks ago. It's not supposed to take just 5 weeks to go from deep oversold to overbought. In fact, I'm going to have to do some historical analysis to see whether this is the fastest move on record. But the reason why it can do that is because stocks were so damaged, so oversold last month that we got into some steep downtrends for the 50-day moving average. So that means it's much easier for stocks to get over that hurdle. So there's two things about that. One is that this overbought signal is not as significant, meaning it's not as bearish as it normally would be, because there's a lot of room to the upside for a lot of these beaten up stocks. And it could take some time for those 50-day moving averages to start turning back upwards, or at least catch up to the price action. And so, number two, what this tells me is that I'm just going to stick with my cautiously bullish short-term trading call until we have some sort of pullback underneath important support. And for my favorite technical indicator, AT50, that important support is this overbought threshold. Now, even when it comes below that, I might go to neutral, but I'm not going to go to bearish, and I'll show you why. In fact, let's just jump over there right now. Let's take a look at the S&P 500, for example. And the S&P 500, let me go to logarithmic on the scale here. It's so far above now these two important support levels, what were resistance levels, but now are support, that the market could easily drop out of overbought conditions, but still warrant a short-term bullish trading call. So that means I am at best going to go to neutral, but I actually don't see a need to until or unless the S&P 500 goes back below these important, what are now support levels. And even if it goes below that, look, the 50-day moving average and the 20-day moving average are both pointing upwards. So I might even dare to just be aggressive and stay bullish until these support levels are broken. So that tells you a lot about how fast sentiment has changed. Think about the macro environment. We went from this tariff drama and trauma. You can see all the call outs here on the chart to tariff pauses, to carve outs, to backtracking, to walking back. I think the market really disciplined our policymakers. And I think going forward, at least for the duration of these pauses, both the pauses on reciprocal tariffs and the pause on those extremely exorbitantly high China tariffs, we're going to have an era of just complete bliss in terms of, again, the market technicals. And but what I still am wary about, and I'm keeping this in the back of my head, is that as we get to the ends of these tariff pauses and there aren't enough deals being done, or at least significant deals, then we might run into some trouble. But for now, we're all good, and I'll show you some more signs of the complacency that's supporting the current bullish action. Okay, so let's look at the NASDAQ. The NASDAQ, same thing. It's got a 200-day moving average breakout. It looks just as bullishly healthy as the S&P 500. I don't need to spend much more time on that. We have the small caps. You can see here this nice uptrend that I've drawn before is holding firm. I did miss a bit of an opportunity here to buy into some call options going into the weekend. Again, I was being a little bit too nitpicky. I wanted IWM, which is the iShares Russell 2000 ETF, to touch this line before I traded. And one of the reasons why I'm being a little picky, because I already have a large core position in IWM shares. So I'm not pressed, I'm not rushing to speculate on additional call options around that core position. Let's actually take a look before I go into some individual stocks. Sorry, let's go to the VIX, the volatility index, and see what it's doing. I'll show you the amount of complacency we have now. So you see the reverse V that corresponds to the big rally we've had. The volatility index has pretty much been going down almost every day since this peak. There are very few days it went up or even held steady. And now it's right back to where it first started launching into the tariff drama. So, for us technicians, we need to be careful that this might end up being support for the volatility index. But, no need to worry until the VIX actually turns upwards. Otherwise, I still assume that this nice steep downtrend and this momentum is going to carry it all the way back to these levels of complacency from the beginning of the year. Sorry, I shouldn't call it complacency. It's just when everybody was really bullish about the prospects for stocks and the economy and so on. And I think we could actually, or not we, but the stock market could actually push volatility all the way back down to where it was here in December. So that's what was that? That was 12.76. The VIX is now at 17.25. So if we think that the volatility index could drop another 5 points, that is a lot of rally. That's enough of a rally to push the S&P 500 at least back to all-time highs, something that definitely was not on my radar just a month ago. All right, let's take a quick look at AT200, which is the percentage of stocks trading above their 200-day moving averages, just to see um, how healthy market breadth is on the longer term. And you can see that finally, now I'm not going to bother going into the regular scaling on this. You can see finally AT200 is now above its last high. So now the lower lows, lower highs are done. The downtrend is over and it's all the way back up to 44.6%. And that means that it's got just a little ways to go to close the gap from where it started this year. So that's a lot of healing for long-term market breadth. And like I said earlier, because a lot of these 200-day moving averages are trending down for individual stocks, this indicator could continue to go much higher. I mean, I wouldn't be surprised if it doesn't top out until somewhere like where it topped out last year, say 68, maybe even 70. So we'll see. I don't want to get too far ahead of things, but that's just something to watch out for. Okay, let's take a look at some individual stocks. Retail, we had bad consumer sentiment. I think I heard it was the second lowest on record, something like that. Don't quote me, but I think that's the headline I heard. But never mind sentiment when consumers are actually doing enough to send the Spider S&P Retail ETF or ticker symbol XRT to a 200-day moving average breakout. So hey, I'm going to be a buyer of XRT next week until proven otherwise. So very clearly, if something's breaking out above the 200-day moving average, it's a buy, particularly if that 200-day moving average is not too steep. And just as a reminder, I'm providing this information for educational purposes. Please use your own investment horizons and risk tolerances to decide on how to trade and to invest. Also, while I'm on this topic, please like and share this content so the algorithm will know what's up. You can subscribe to my channel to get alerted to this kind of content. And if you have any comments or feedback, put them down below. And you can also check my blog at drduru.com/122, all letters, to find more detailed descriptions of my market observations. Okay, now speaking of retail, Wayfair is approaching its 200-day moving average. And that's going to be an important moment because look at how the 200-day moving average has pretty much guided Wayfair down. And in fact, it held it tight in earlier this year. So I'm keeping an eye on that. A breakout, a confirmed breakout, which is two higher closes above, would be very bullish for Wayfair. Okay, Coinbase was a big one. I have a position. I've got a call spread on this that I bought after earnings came out. I'm pretty bullish on where Coinbase can go to. Right now, it closed the week at 266. I'm thinking it could get very quickly to 300. My call spread, I believe, is three. Don't quote me on this. I think it's 300 to 300, 315. That's how bullish I am over the next month for Coinbase. And part of that is because it was a very strong earnings reaction above the 200-day moving average. I know it pulled back on Thursday sharply on some bad news about a hack and some old news on a DLJ or SEC investigation. And you can see that today the stock rallied right back up. I mean, 9%. In fact, I think my positioning was not bullish enough given this kind of snapback for Coinbase. All right, Carvana, let's take a look at a very speculative stock. You know, after all that tariff trauma and drama, look at this. Carvana is already at a new high for the year. Let's pull this back. You know, Carvana incredibly is now still reaching for its all-time high. I can't even begin to understand and explain this one, but kudos to anybody who stuck with Carvana over any period of time after buying the stock. You can see, I mean, anyone who's sold down here at the single digits is really crying a river at this point, or anybody who somehow shorted it and somehow is still short. Oh my goodness. I did buy a put spread on Carvana as sort of insurance for a crash. And of course, that crash never really happened. First Solar is back on my radar because it had a very strong earnings report. It soared 22.7%. It's had some good tariff news in terms of the industry, U.S. industry being protected, and it's back on my buy list. Now, I did not rush out to buy it because it is well above its upper Bollinger Band. As a reminder, the upper Bollinger Band describes two standard deviations away from the 20-day moving average. It's another way of saying this is the expected volatility of price in terms of the price range over 20 days. And you can see it was a good thing I didn't rush to buy with First Solar Silver Extended because the last 2 days it pulled back and is now below its 200-day moving average again. Now, the reason why I like that action is that I know to just stand on the sidelines for now. But even more importantly, I know that if it closes above the 200-day moving average one more time from here, I'm just going to be aggressively buying the stock. That's going to be all green lights. So right now it's at 178.46. Getting above the 200-day moving average again would be, let's just say at 184. Okay, Uber. Uber's another one. I can't believe, I've been bearish and skeptical of Uber, the stock, for a long time. It has now broken out to an all-time high. What that means is, and it's trading at 91.79 This means that Uber remains a buy on the dips. You can see that ever since the tariff drama, the dips have been have been few and far between. So if you want to buy into Uber, you're going to have to chase. I'm not one to chase, so I'm just continuing to sit back and watch. I'm back into Corning Incorporated, ticker symbol GLW, what I like to call glowworm. It had a confirmed breakout above its 200-day moving average. and that was a buy signal for me. And I went ahead and bought in. I think part of the news here was that they announced some deal with a data center to help speed up communications in the data center. It's an AI data center. And that means, hey, Corning becomes an AI play. And I love AI plays and I love finding excuses. Corning, I believe, also has a very low valuation. So it was made it very easy to buy. So I'm very bullish on Corning. If I didn't have shares now, I would buy it even right here at 48.22. NVIDIA, since we're talking about AI, um, if you recall from previous writings and videos, I've insisted that this latest bearish engulfing top that NVIDIA started the year with meant that NVIDIA will be topped out for months. I think I'm still going to be right, but it's going to be a close call. We are now, what is this, 4 months into this top. At the current pace, NVIDIA could be retesting these highs maybe in about another 3 to 4 weeks, and then the rubber will really hit the road. But I think, 5 to 6 months staying under this pretty much qualifies as making my prediction come true. But anyway, that doesn't even matter because Nvidia is back in a bullish position. So I'm not even if I were to trade this, and actually I have been trading Nvidia vertical call spreads and calendar call spreads, just very low risk positions. I've been trading it all the way up here. But if you want to buy this as an investment or a trade, sorry, if I were to buy this for an investment or trade, I'd have no problem buying a little here and then buying on pullbacks to 200-day moving average support. In other words, yes, this bearish engulfing top is still looming above as resistance, but this shorter term signal, actually, it's not even a shorter term because it's above the 200-day moving average. This makes NVIDIA bullish. And so many stocks, of course, are in this position now that they have now become bullish. Okay, next up is JB Hunt Trucking Company. If you didn't think that the tariff news was being interpreted positively, then JB Hunt and other transportation services would be your signal. Check out this 50-day moving average breakout. I had bought as a hedge a put option on this stock somewhere around the 20-day moving average. Actually, maybe it was a little higher, but regardless, um, like so many stocks, JB Hunt is leaving behind its bearish positioning. Now, it's still well below its 200-day moving average, so it still has a lot of healing to go. But this is not a place where I would be shorting the stock. And I'm just hanging on to my put, just keeping the hedge on. Okay, I keep talking about the discount retailers, and I somehow missed Dollar General Corporation, ticker symbol DG. Look at this picture perfect. Let me zoom in. Look at this picture perfect test of 50-day moving average support right there around $87. Wow, that was amazing. I got distracted because I was too busy selling Dollar Tree. And I will go to that chart really quickly. And I'm pretty sure, and one of the reasons why I went ahead and sold is because earnings are coming up. I didn't want to hold my position there, but it fell so fast off of this last high and filled the gap that I felt like that was a warning signal. But you can see the sellers stopped cold right there. I would have been more inclined to continue holding, except for the fact that earnings are coming up, and I think they're going to be fraught. But yeah, I will be looking to see whether it provides a new entry point because look down below, we have a converging 200-day and 50-day moving average lines, and that should provide solid support. And this is around 74, 75. It'll be a little bit higher support by the time the stock ever gets down there, unless earnings sends it there quickly. Gold, here is one where the bearish engulfing top is in place. Look at that. Look at how perfectly it called the top and how perfectly GLD, the Spider Gold Trust, came right back to that previous all-time high and stopped cold. And sellers have taken over ever since. I love though that gold is or GLD is now testing the 50-day moving average support. I of course had to go in there with some call options. I'm not ready to rebuild a core position of shares in gold. And in fact, I wouldn't buy GLD. I would buy PHYS, which is the actual physical commodity. But anyhow, this is a good setup for fresh buys. And of course, it makes it easy for a stop loss to just basically stop loss below the 50-day moving average. But I love this uptrend line. I would love to start building a core position on a pullback all the way to this uptrending 200-day moving average, but that's, quite a ways away. For now, I'm just going to do short-term trades with the call options. Okay, we're almost at the end here. Impinge. Now, this is one where I sold today, got a 30% gain. And the reason why I'm mentioning this one is because it had all the elements of a clear buy. I've written about Impinge before, ticker symbol PI. After earnings, it popped, what was this, 16.5%. That's a lot, of course, but I just watched and watched and watched. You could see it lingered, and then it gapped down to 50-day moving average and then held perfectly. It held the 50-day moving average support perfectly here, right here at this red line. And that was my signal to be on guard to buy. And I did indeed buy somewhere in here. I can't quite remember, but this run up, I mean, you could see that the sellers just have been completely absent and Impinge has just floated higher. Now, I decided to take profits here because Impinge has finally closed the gap from last earnings, sorry, the previous earnings, and I've got 200-day moving average resistance looming above. I'm all too happy to buy any pullback for PI, but I'm also not going to regret selling it if it just continues higher from here. If I were to regret anything, is that I wasn't aggressive enough in buying this position, but I really thought that there was still a good chance that Impinge could fall back to, say, 20-day moving average support, and I wanted to have some powder left to load up on more shares. Particularly if it filled this gap, this earnings gap, I was going to load up right there, but it never happened. And this is just what can happen when you're doing risk management. All right, let's end this with Caterpillar. I'm ending with the best. Caterpillar Incorporated, ticker symbol CAT. This is the stock that made my week. And ironically, I use Caterpillar as what I call my hedge on bullishness. But with the China tariff, sorry, with the Chinese and the US and the Americans meeting last weekend to do tariff talks, I looked at CAT and I said, typically I would buy put option just in case the talks ended poorly. But there were just too many signals that at least nothing bad was going to come out of that weekend. I mean, Bessent himself has said before, U.S. Treasury Secretary Bessent has said before that the tariff levels were unsustainable. So we knew that going in, that the U.S.'s attitude is they got to figure out how to bring both countries back from the brink of trade disaster and a complete seizing of trade. But it wasn't possible really to predict just how big a day Monday was going to be on good news because they went all the way back, to this whole tariff pause thing. It wasn't just shaving the tensions off on the edges. They rolled back tensions big time. So anyway, all that to say, I took a different lens on Caterpillar. I said, you know what? If I wasn't using the stock to hedge on bullishness, I would be buying CAT here. So let me go ahead and buy one single call option and just speculate. I did that and CAT soared 5%. I know that doesn't sound like a lot, but for the call option on Caterpillar, it was a lot. I think it was a triple or something like that. So it really made my week. And it was a good trading lesson for me that there are good times to just step back and just read the technicals without any other biases. And it worked out. Sometimes it won't work out, but when it does work out, it can work out big like this. And that's exactly what we want to see on trading. Now, what do the technicals tell me now? Is if I were trying to use Caterpillar as a fresh hedge, I would be buying put options because it's hovering right below the 200-day moving average as resistance. And you all are going to laugh at this, but that's exactly what I tried to do. I bought actually a vertical spread because I wanted to reduce my cost of the hedge. Sorry, a vertical calendar put spread. And it actually, and sorry, I said vertical. I should have just said calendar put spread at the 345 level. And given the move today, I would have expected to go into the coming week with a put option, a long put option, but instead my initial profit target was triggered. And so what I always do with my spreads is I always put in an initial profit target. I like to do that because I learned my lesson in terms of sometimes I get surprised by big moves that go right through my strike, and then I end up having nothing, or sometimes even a small loss, which is always painful when you get things right direction, but then you actually end up losing. So anyway, I think given Caterpillar's positioning, I still have time to buy a put option as a hedge, but honestly, I'm not excited about it because Caterpillar looks like it really wants to break out above the 200-day moving average. And once Caterpillar breaks out, or if Caterpillar breaks out above its 200-day moving average, I that will only increase my bullishness on the market for the next coming weeks and maybe months. All right, so that ends that. Again, if you have any questions or comments, put them down below. Thanks for hanging in there through all this time, and I will check you out later. Don't forget to subscribe.